Good morning, everybody. Thank you for attending the Place Your Trades Network Spaces covering North American oil and gas. This Spaces is brought to you by TraderBait, which has a built-in custom app dedicated to trading CME Group's new daily option contracts to trade crude oil, natural gas, indices, and metals. You can use the link in my Twitter stream to go and get the TraderBait app for free. I also write a weekly blog on energy and metals that you can find at placeyourtrades.com. In addition, over the next month, Place Your Trades is giving away a free trip to Vegas for the Money Show. So one winner will join the Place Your Trades team on April 24th through 26th. That's your airfare and hotel and tickets to the show are all included. All you have to do is go to placeyourtrades.com/Vegas and sign up before March 1st. All right. Now moving on to our guests. We have Josh Young. Finally, I've been trying to get him for a while. Our schedules coincided well. He is the founder and CIO of Bison Interests, which is an oil and gas fund. He has built his career concentrating on deep value opportunities for investors. He has over 15 years experience in investment management, 10 of which are on publicly traded oil and gas securities. Josh was a management consultant to Fortune 500 companies and private equity firms, and then an investment analyst at a private equity fund. He worked as an energy investment analyst for a multi-billion-dollar single-family office, which was nominated for Institutional Single-Family Office of the Year in 2008. He was also chairman of the board for RMP Energy in 2017, which he revamped and was bought out at a premium in 2018. Next, we have AyeshaTariq, has over 18 years experience in the financial markets, analyzing companies and investment. She started her career in the corporate banking of Standard Chartered Bank, lending to multi-billion-dollar enterprises. She later joined a family office as head of treasury and was in charge of their multi-asset portfolio of over $1 billion. She's lived in Dubai for the past 16 years. Next, we have Thomas George. He began his career in 2002 at TD Asset Management. He held various roles, including head of resource investments and portfolio manager of the TD Resource Fund, TD Energy Fund, and TD Precious Metals Fund. He's currently co-manager of the Grizzle Growth ETF, which we have another member of the Grizzle team. We have Scott Willis. Scott began his career at BNY Mellon, managing portfolios for ultra high net worth individuals. He later joined Credit Suisse, where he was an analyst covering the energy sector with a focus on exploration and production, refining, and oil field service. He later joined TD Asset Management, where he's a fixed income analyst covering the energy, industrials, and transportation sectors. He is co-manager of the Grizzle Growth ETF. So welcome, everybody. Kind of going to start, we'll go around, and I'll have questions for everybody. But if you have something to add to what anybody else has said, please feel free to speak up. But we will start with Ayesha because I wanted to start more broad-based, and I have some questions on earnings, since you covered those quite extensively. So all of the majors have reported so far, and despite windfall taxes and pleadings to produce more from governments, they've all pretty much stayed the course of the last 2 years, announcing more buybacks, higher dividends, concentrating on shareholder returns. What do you think will be the repercussions from governments for this? Are we going to see more windfall taxes? Are we going to see more blowback from governments?
Hey, Tracy. Can you hear me okay?
Yep.
Just want to make sure that I'm coming out okay. Okay, great. So it's been an interesting year of earnings for the oil majors, and it's actually been an interesting year of earnings for the entire, oil sector, right? With oil prices remaining high, and these companies delivering record results. And yes, what we've seen out of this is, returning cash to shareholders is basically one of the primary let's say, aims of these companies, right? Their goals have been to return funds back to the shareholders, which, if I was a shareholder, I mean, that's great for me, right? But at the same time, I think the concern remains that they aren't investing enough of their cash flows back into the energy sector. And we've definitely seen what's happened over the last year. I mean, it's been one of the biggest shocks that we've experienced in terms of, the oil industry, at least, in the last decade or so, right? And it's been the entire situation has brought to light the fact that we have severe underinvestment in this sector, and in the face of that, you would think that these companies would invest more into exploration and production, and some are. I'm not saying that they're not. Obviously, Exxon is doing it, Chevron to a certain extent, but there could be more. So I know that there's been some talk about windfall taxes, but I don't see that windfall taxes helping with this, because I'd rather think that by taxing these companies, where are the funds really going? They're not going back into exploration, are they? So for me, I would rather say that maybe there should be incentives for these companies rather to invest back into the sector versus actually taxing them. What do you think?
Absolutely, absolutely, absolutely. I agree. You cannot. I think everybody on this panel would probably agree with that one.
Yeah. Ayesha, I think the challenge is, like, we all agree. It's just that the governments there's just such a disconnect between what some of these governments think, their view, and the energy crisis that we're seeing, and it's just that's the challenges, round peg, square hole kind of thing.
Yeah, no, I think absolutely. Sorry, no, absolutely, you're right, Thomas. I think this has been the biggest problem in the sector, right? Like, all these years, for decades and decades, the government has just been ignoring or trying to curb the oil majors and trying to curb the oil production companies. But now, suddenly, when they're faced with reality, I mean, it's like they've suddenly woken up, right? Sorry, Scott, you were saying something. I cut you off.
Oh, no. I was basically just saying I think we're stuck in a cycle of energy shortages equal more windfall taxes, which equal more energy shortages. Because what you've seen they've done, this year, it didn't lead to any more drilling, but they took, potential reinvestment proceeds away from the companies. So politically, that makes sense to do that because it looks good on your soundbite, I think. So that's probably what will happen if we have another shortage type headlines next winter in Europe.
Yeah, absolutely. Absolutely agree. If you look at companies like Exxon, who had $1.2 billion in excess taxes, so for windfall taxes, so that's quite a chunk of money.
Tracy, I just posted in the Nest, just speaking to Ayesha, and just the comments here, just share of energy total cash spending. I just found this graph. I thought that probably illustrates this in the best possible way, right? Just looking at CapEx and R&D, and you can just see that it's been in decline since 2010 as a percentage of total cash spending. And when you're not incentivized to put dollars into the ground, well, what do? You buy back shares, you give it back in dividends, right? And that basically is the story right there.
Absolutely. Fantastic chart. Thank you for the post. Everyone should check that out. I'll move on to Josh. We're going to kind of bring this down a little bit from the majors. Big oil is always a hot topic. This is what we mostly hear about in the media, but you talk a lot about more of the mid to small caps, particularly in North America and Canada and the US. So what do you see as some of the advantage to some of these, say, over the majors that everybody is used to hearing about?
Sure. Yeah. Thanks, Tracy. Well, just first, real quick, since we're talking about earnings, there have been two reports, I think, that are worth mentioning, incidentally, of larger companies. So one, and I try to follow them all just because it's really helpful. And sometimes I'll invest in larger companies. I've just been finding more value in smaller cap producers and services companies. So the two that are really interesting are, one, BP is moving beyond petroleum and is increasing their oil and gas capital expenditures versus their prior guidance. And their stock rose dramatically. I think they announced that yesterday, and the stock was up 8% or something like that. So that was really interesting and noteworthy. And then Weatherford, which I have a small sort of related position in, as a full disclosure, they had an absolute like blowout earnings report, and their stock is up more than 10% right now. Their earnings were up 4x. And I can't remember if it's year over year or quarter over quarter. Their revenue is up 30 or 40%. So these are both sort of very interesting. Weatherford's a company that's been off everyone's radar, which is, I think, why the stock has done so well, and why I had some exposure. So anyway, those two I think are noteworthy earnings reports that have come out so far this cycle. Small caps I think are interesting here. It's going to be, I think to push back on Ayesha's sort of more political commentary, the specifics around the economics for these companies are very challenging. And I was talking to a private operator yesterday who was saying that he didn't think Permian oil wells were economic with the new higher services costs at $75 oil. And so, I think sort of there's a lot of political grandstanding, but there's also just a reality, which you can see, I think, most easily looking at the financials of these small producers and small services companies. And so obviously I try to own ones that are highly economic at current prices, but sort of in aggregate, when you look across the industry and you look at the specific activity, I don't think it's reasonable to expect companies to engage in activities that are not high return on invested capital. And at current oil prices, that sort of activity is not high return. So it seems like companies are just sort of responding rationally. And I think the way that you get more activity from here is going to be much higher commodity prices.
Yeah, I would. Well, obviously, yelling at oil producers is not working, right? Like, as our government is currently doing. And so that kind of leads me to the other question that I was going to ask you about, is kind of in terms of U.S. and Canadian oil production and nat gas as well. Where do you see this in terms of growth, given that there's so much kind of pushback against governments, telling these companies that they want to phase them out? And kind of growth estimates from all the agencies are kind of all over the board. So what do you think is realistic as far as production growth in the US and Canada?
Yeah, and again, I think there's sort of the fun to talk about on Twitter, and then there's a sort of actual process of companies engaging in capital budgeting. And the capital budgeting, I think, has very, very little to do with politics. Whether a president or a senator or a regulator says, hey, I want something or not, companies almost always are just going to engage in economic modeling on what they're expecting to do. And then, maybe they'll have a slightly higher discount rate in a place where they tell them to go away, and a lower discount rate where they tell them to, where they welcome them. But again, it's still down to economics. So the economics are interesting, right? So for shale, on the oil side, it looks like a number of wells are way less economic than people expected. And there's been a slowdown and actually a recent drop in the oil rig count, including in places like the Permian, West Texas and Southeast New Mexico. On the gas side, most gas wells just went uneconomic in terms of new drills in the last month and a half. I don't know how long natural gas prices stay this low. Maybe they go even lower in the short term. Production was expected to grow by a few percent year over year. And even by a few percent just sort of from the start of the year level. I think we were producing around 100 BCF a day, and the consensus was 102 versus last year at this time we were producing around 95 BCF a day. So those rigs are starting to fall off rapidly because you can't really make money drilling a shale well at $2 or $2.50 natural gas. So I think you're actually going to see, at least in the US and Canada, a slowdown in drilling activity, particularly on the gas side, and you may see significant underperformance from a production perspective in 2023, absent a substantial change in the underlying commodities.
Excellent, thank you. So move on to Scott. Let's talk a little bit about Canadian oil and gas, and we'll get into a little more depth. I mean, we've seen Trudeau essentially shun Canadian LNG. And, both Germany and Japan basically came looking to Canada for long-term LNG contracts, and instead, Trudeau offered the Germany hydrogen and Japan battery metals. So obviously, this has not pleased Alberta. But what does this say for the industry? And is there growth potential in the LNG industry for Canada? And what are some of the obstacles that they might be facing right now?
Yeah, those are all good points you make. So I think there is growth potential for Canadian gas producers from LNG, if not in Canada, in the US, because we've already seen some Canadian producers sign agreements to ship their gas down to the Gulf Coast. We know that there's big growth coming out of the Gulf Coast on the LNG front. And so as they're successful signing those agreements, granted, it has to be at a discount to a producer in Texas because of the cost of transportation. But we've seen that, the LNG guys are willing to sign contracts. And then I think a big kind of catalyst to watch for, we'll see that first LNG kind of new build coming online in Canada, just to see that it isn't delayed by something regulatory. It seems like it's moving along. I think it's planned, LNG Canada, it's called, planned for 2025. We just want to see that start up because that'd be a big milestone. It shows that Canada's willing to let LNG operate in the country. And we noted that it's economic versus the US. It's closer to Asia on the West Coast. So that could be the beginning of the floodgates. But so far, the government has continued to put roadblocks. I remember I tweeted a while ago that I looked at all the contracts that were supposed to be in place and the projects that were supposed to be built, say 2016, what was planned. Canada had as much capacity as the US planned. None of it came through. And you look at the US is now at 12 BCF a day of capacity. So it's been a really stark contrast. So that is kind of a headwind to the Canadian guys. But if you just look at the producers specifically, they have pretty good cost structures. There's good wells, low cost wells there. So they can compete. It's really just make sure the pipelines are there to get that gas down to the Gulf Coast. And then upside could come if we have more LNG projects built in the next 4 or 5 years after that LNG Canada starts up.
Is there anything specifically in the works we should be looking at as far as pipelines to the West Coast are concerned? I mean, I know that there's been problems after problems, but is there any promising project that looks like it could be completed within a reasonable time period?
Not really. I think if you saw that the LNG Canada, they're having to run their facilities on natural gas instead of electricity because the grid just isn't built up there. That's another issue when you're kind of going in uncharted waters and you're building in an area that doesn't have infrastructure. That's going to slow things down and increase costs. So they have the pipelines are going to be ready for that project, but we haven't seen big new pipelines get signed for growth beyond that. So I would watch that because I think, what comes first is they sign some offtake contracts. So if you hear of new LNG facilities signing, say, 20-year contracts with an Asian buyer, that's kind of the first step. Then you break ground, you start building, then you'll sign up the pipelines. And that's kind of like the order of things. So I'd be watching for contract announcements first to make sure that something else would be coming from Canada.
And Tracy, maybe I can add 2 cents on the political spectrum there, right? If we can get Pierre Poilievre, like if we do see a change in government, I think it's very clear where the pendulum will swing significantly towards at least taking down many of the barriers and regulatory barriers that have plagued Canada. Further to Scott's point, these are stark numbers when you think about how America's been able to increase LNG capacity. Obviously, we're not even talking Qatar globally, right? But where Canada sits, and Scott, correct me if I'm wrong. Like we got the third or fourth largest. Like we have one of the largest natural gas resources in the world, and to be sitting where we are right now, it's very unfortunate.
Yeah, there's actually, I was looking at it today, there's an opportunity for Canada to supply even Mexico. Mexico now gets 70% of their gas from the US. And so as our prices stay low, we have lower production costs. They're really ramping up how they get their gas. So there's an opportunity for Canada, again, if the pipelines get built, which so far have been adequate, but Mexico is kind of insatiable for US and Canada gas. So that's another opportunity, not just the LNG exports.
So on the LNG side, which do you like better, US or Canadian producers at this juncture, or are they equal?
In the long term, so when I say long term, LNG, I'm generally thinking of it out to 2026. Past then, it's harder to know what's going to happen, but things look very promising from now to 2026. So on the longer term, I like the US guys because they're just closer. A lot of them are in Texas. They're very close to the facilities. But this year, where gas prices are, Canadian gas names look a lot better. They have lower costs, and they're going to produce more cash flow at these lower gas prices than US guys. So if you look at some of the US guys that pay dividends, those would be in trouble at $3 or below. The longer that goes on, they don't pay much of dividends, but those would go away. And if you look at the free cash flow yields, Canada looks much better. If you think prices are going to be $3 or less this year, you own Canadian names all day. If you think prices are going to be $4 MMCF or above, then you start owning the US names. So in the short term, like Canada a lot better. Over the 2026 period, I like US names because they just don't have to worry about pipelines being built to go across the country. They just have to be local pipelines.
Thank you. And so moving on to Thomas. So across the energy spectrum, we'll broaden out a little bit, across the energy spectrum, how are you guys allocating assets and your favorite sectors, whether it's O&G or services, etc.?
Thanks, Tracy. Yeah, maybe I'll just start at this very high level. So the way we think about it opportunistically, we think right now is the best time to execute a barbell strategy. Of course, it's a much higher perspective, but I think it's very valuable. A barbell portfolio strategy of, on one side, you have growth stocks, and we are much more favorable to large cap value US tech, call it Microsoft, Meta. So that's one area, but the other side is commodities. And coming back to what Ayesha was saying, and just I put another chart up there, another look at this. This is in the nest. This is S&P 500 energy capex as a percentage of operating cash flow. Again, when you look at it, this is going back all the way back to 1990. It's pretty impressive how low we are on that capex spending. So from our perspective, this dynamic holds through for mining as well. So you have this natural setup where we haven't been spending enough. So that, to us, we are bullish, and we, in addition to that, we're in an inflationary environment. So from our perspective, we do love commodities. And our rank order, if I could lay it out, is at the top line. We functionally believe that natural gas is one of the best. Bridge fuels. Now, if you do believe that we do get to a world with nuclear or more renewables, all that stuff doesn't come on immediately, and there's only one source of energy that can come on pretty quickly and meet the world's needs for energy globally, right? And we believe LNG is that fix. So for us, natural gas is key. We are bulls in oil, and we also believe that on the mining side, specifically battery metals, copper, lithium, nickel, and vanadium, we believe that there's opportunities across that entire spectrum. And our real bullish thesis is based on, I have strong visibility that there hasn't been any capex put in the ground till now, and going forward, that is going to still take time for all of the main ESG type reasons that I know that is discussed in great detail. I won't get into it further, but again, that acts as a tailwind for what we believe is a structural bull market for commodities.
Yeah, I mean, I absolutely would agree with that. I mean, if you want to mine battery metals, you need oil and gas. So it's kind of a vicious cycle. But kind of along those same lines, how are you seeing other portfolio managers positioned in the energy sector?
Yeah, I'll throw something up in the nest, and I think just big picture, from an asset allocation perspective, I try to keep tabs on just how big asset allocators are thinking about energy, and I think there was always historically up until last year, right? I think we're still baby steps into this. Historically, when we're talking about large pools of money here, right? Obviously, we're looking for where's that next big slug of capital coming from. Our view is still that we are structurally significantly underweight energy as a percentage of the total market cap of global equity markets. And one way to think about that right now, energy as a percentage of the S&P 500 is just shy of 5%. So if you were to look at that historically, let's just even going back to the 70s, like what you'd get to. So in 2007, 2008 time, the S&P 500 was just north of 14% of the S&P 500. We're sitting at 5. So simple math here is that we think that energy should be a much higher component of the S&P 500, and there go portfolio managers, asset allocators will continue to allocate capital to this sector, and we believe that dividends obviously are income will be a key component of why they're going to do that. But net, that inflationary aspect will continue to drive portfolio managers into the sector. So from our perspective, commodities, but energy specifically, you'll continue to have tailwinds of capital flowing into the sector. And I'll post something into the nest right now, just showing exactly what I spoke to.
Perfect. Thank you. So go back to Ayesha really quickly. So there's a lot of talk from, the big 3-letter energy agencies, IEA, EIA, et cetera, about how renewables are going to overtake oil and gas by 2030. In fact, IEA just came out and said renewables will be the top power source by 2025. Then we also saw BP's latest deck was their outlook was for renewables was also extremely, I think, convoluted, especially given on the fact about how Josh mentioned they backtracked on their goals and making ESG a much smaller portion than was initially allocated out to 2030. So how realistic, kind of walk us through this a bit?
Sure. So, look, I don't think this is very realistic. I'm sure they're going to try to reach these targets, but from what I've seen, and to be fair, I mean, most of the oil majors that, I've been involved with are European oil majors. So the likes of BP, Total, and so on and so forth, because they work more in the Middle East than, the American companies. And most of these do have a target of, net zero and, so on. But realistically speaking, I'm not too sure that, we can completely switch from oil and gas. Anyone who's involved in this sector will tell you so. I'm sure you believe the same. And all of us know that the way that this transition is being done is it's not being done well. Let's put it this way, right? So I think what we're trying to do is pull the plug on oil before we have anything else in place. And clearly, the last year has taught us that that's not going to be the way to do it. We can't force these targets on people, and we can't think that, we can just magically snap our fingers and everything's going to change overnight. It's not. I do think that we will see oil and gas being used far into far beyond 2030, let's say. And by the time we actually switch over, and I think there'll be a long period where there'll be, we'll have clean energy and we'll have, oil and gas. But I don't think this is a realistic target at all.
Well, yeah, and I mean, speaking of that, I mean, we've seen in the Middle East, we've seen those, specific countries in the Middle East that basically are on board with that, and we're seeing growth. We're seeing growth projects in all over, right? Saudi Arabia wants to ramp up their production capacity, and I think that project's completed in 2027. We saw Qatar have one of the largest natural gas projects in the entire world that they're starting on. So, do you think this is going to hurt, say, the North American oil and gas companies?
To a certain extent. I mean, I can speak to how things are taking place in the UAE. From what I see, both are running very much in parallel. Okay, so we have our clean energy sector, we have all the initiatives, we have people doing conferences every month on these things, but at the same time, no one touches ADNOC, which is Abu Dhabi National Oil Company. I mean, they are running as they are. And in fact, they've increased their production targets. And if you remember, there was a big fight last year for them to, increase their oil production. So that's not going away. So what the UAE is doing is sort of running both in parallel right now and, hoping to have a viable clean energy sector, but not at the same time, not penalizing the existing sector, right? So I think that's a good way to do it, because they clearly understand that oil and gas is not going away, and they understand that oil and gas is important to their livelihood. I mean, to the entire livelihood of the Middle East, right? So they can't just get rid of it, and I think it should be something similar in the US as well. But that's not how it has been implemented so far, right? Scott wants to say something.
Yeah, I think the opportunity for gas, at least in North America, is that I just have been doing a deep dive this week on what's going on with gas. And if you look at what's being built versus retired, they kind of cancel each other out over at least the next 4 or 5 years. So the industry isn't planning to ramp up gas's ability to supply our electricity. But we know that demand for electricity is growing quite strongly because of the adoption of electric vehicles. And then if you look at what's being built to support this growing demand from electricity, so far it's renewables. This year, the EIA thinks that 70% of new energy is going to be renewables. The problem is they're not as reliable as gas and coal. And so I think we may get to a point where right now there's no plans to build gas-fired power plants. Basically, they're being built to replace the ones that are shutting down. But you get to a point where you're building all these renewables without battery backups, and you need them to be reliable. You can't have them going, off and on all the time. So as demand keeps growing strongly, they'll be like, oh, wow, we need a lot more energy, baseload energy. Well, we're not building coal plants. Nuclear is taking time. It may take, another few years to come on. So in 1 or 2 years, you build a gas plant. So there could be upside for gas demand in North America as more plants are built than what is currently anticipated.
Excellent points. We'll go back to Josh. So we'll go more on nat gas. So we've seen nat gas. Well, we've seen globally nat gas fall from the summer highs, right? And so when do you see prices rising again with Freeport reopening and separate energy Port Arthur expansion, or kind of what time frame do you think we'll see prices rise again? Because I get asked this question a lot. And I think a lot of our listeners would like to know, kind of your view on natural gas prices and if they are going to raise again.
Hey, Tracy. Yeah, that's a great question. And actually, just as a add-on to the prior comments, so I actually have exposure to a position. So I own the stock in Canada. It's called Journey Energy, and they've been ramping up their gas power gen aggressively because in Alberta, the government's been both the Canadian federal government and then the province sort of enforces this. They've been imposing carbon taxes and sort of forcing coal power plants out of operation. And so it sent local power prices super high. I think Scott or Thomas were talking about this, LNG Canada and other various projects, even that are powered or that are transporting natural gas, are having to build some of their own power gen because the local power situation is such a mess. And so where we see a mess and bad policy, sometimes there are great opportunities. And then one of the things for natural gas is that there's a number of plants. I heard about this at a conference I was at last week. There are a number of plants, natural gas power plants, that were built as peakers. So they were built to run when it's really, really cold or really, really hot, and then just to stay on, as backup generators so they don't run most of the year. Many of those right now in the US and in Canada are running as sort of base load for power. Because maybe they don't run 100% of the time, but they run when the sun isn't shining or the wind isn't blowing. And so you might end up with a power plant running 18 hours a day or 12 hours a day that was only built to run a few days a year. So we're seeing this for natural gas demand. There are some companies like the one I mentioned that I own that are benefiting from this aggressively. And then many are also sort of exiting the business, shutting down these plants. And so there's just really interesting economic opportunity. In terms of gas demand specifically, and the gas price, I think it really depends on what producers do over the next year or so, as well as what power generators do. So to the extent that power plants that were supposed to be decommissioned stay on or shift from, let's say, coal to natural gas, you could see demand bump, especially with these low prices. And that would be true even, let's say, at $1 higher natural gas price than you're seeing right now, especially on some of the local bases where you might see a price of $2.40 or something at NYMEX. But if you're in Louisiana, maybe you're getting $1.80 or $1.70 or something right now. So they're really, really low prices in certain places. So if there's a little more demand than consensus, and if there's less supply as producers slow down on their drilling, and as the gas rig count drops, you could see a balance where you could see natural gas prices settle out somewhere higher than here over the next, let's say, 6 months or so. But I think the big sort of light at the end of the tunnel is along the lines of what Scott and Thomas were talking about before, with LNG export facilities starting to come on in 2025 and 2026. So that's a few years out. It's sort of painful to think that natural gas prices could be low for a long period of time. And I think the reality is that, a $4 price, even though that would have seemed really low last year, would seem really high in the current supply demand environment. And hopefully producers will sort of rationalize their activity. They're starting to, but hopefully they'll continue to. And then hopefully power generators will take advantage of this low price too and ramp up their power gen like certain ones are, or at least slow down on their decommissioning.
Well, go ahead, Scott.
Yeah, I just wanted to follow on that. I mean, you look at what happened to gas prices. There was a lot of sentiment driving gas prices a few months ago when we got to $9 an MCF. We didn't really need $9 long term. It was just when Europe was in crisis and needed gas, we were tapped out in how much LNG we could send them. It didn't matter how much extra they needed. We could only send a certain amount. Prices still went to $9. So if we get to next winter, I tweeted something today showing that Europe, dealt with their crisis by just drawing down some of their storage, burning a bit less, but mainly it was just drawing down storage and then using less. Well, you can't continue that forever. So next winter, if you have a normal cold winter, there's basically 13 BCF up for grabs. Now that's the size of our entire LNG industry in the US. So there's a big opportunity for them to still need a lot of gas. And then there's headlines, all the usual headlines, Europe in crisis. And then you have prices go up because they need to, just because there's more LNG going to Europe. But sentiment kind of gets ahead of itself, and then you can have prices run even more. So at 250 gas, as Josh said, it's not really economic for guys to keep drilling. So you'll see activity fall. If I'm a betting man, I think that it'll be higher next winter, just if we have a normal weather winter. Because right now, it's like 40% warmer than normal.
Yeah, and along that same vein, I would almost venture to guess that even this summer, because a lot of Europe's power depends on natural gas. So even with air conditioning this summer, if they have a hot summer, those could draw down, their stocks could draw down a lot more than they anticipated. And so you have to remember that last year, 50% of their gas storage was filled from Russian gas that wasn't shut off right away. So what is anybody's thought? This question is for anybody on the panel. Thoughts on drawdowns this summer, even before even next winter?
That's a really good point, because I don't know if anyone remembers, there was water issues with nuclear plants because of the warm weather this summer, and those weren't running as much as they could. So if you have a hot summer again and you have low water levels, that leads nuclear to underperform, and then they need even more gas again.
And maybe just a question for everyone out here. My bigger picture is, obviously Europe was fine, but you have places this winter like Pakistan who are dealing with rolling blackouts, which is a function of the fact that Germany took all the they were the net buyer of all all the natural gas. I just wonder, in a more normalized environment, where Pakistan isn't dealing with rolling blackouts, like they can get their natural gas, like shouldn't we be net in a better position, assuming not distressed pricing, super high pricing, but let's call it like more more reasonable pricing, where that should be better for the global industry.
Does anybody want to answer? Well, I think that I'll just answer what I think. I think right now what we're going to see is Asia demand ramping up right now, especially with China reopening. So I think a lot of cargoes that would be going to Europe are going to be diverted to Asia now, instead of vice versa, what we saw this summer. And so that could also lead to problems for European storage as well. Just my thoughts on that.
I think it's a big deal that China was locked down for a big portion of that restocking period, and I think we're starting to see some industries. So some industries that shut down in Europe may not turn back on, and that's really bad for the European economy. And it's going to be really interesting to see how they recover, or how they attempt to recover. And there may be a lot of stimulus and a lot of money printing in Europe to sort of make up for some of these industries that turned off, but some of them are going to turn back on. So you're going to have higher demand in Europe than at least you've had over the last, let's say, 6 months. And you're going to have, like you're saying, Tracy, some of these cargoes redirected. And maybe you're going to have a lot, because rolling blackouts lead to riots like you saw in Sri Lanka and elsewhere. And I think there's just a limited tolerance for that, especially at these much lower prices than we saw over the summer. So yeah, I think it could get tight again, probably not to the price level that we saw at sort of the peak, but that was what, like $1,000 a BOE equivalent, or a barrel equivalent for natural gas at one point. So I don't know that we get that high, but we could get way higher than we are right now.
Yeah, I absolutely agree. So let's talk about let's talk about a little bit about portfolios. I mean, I think we're all pretty much agree here. We're kind of all in agreement that oil and gas is going to be around for a long time, although we have governments phasing out, or wanting to phase out O&G. So and kind of demonizing the industry. So what's the case, and this is for anybody, what's the case for higher oil and gas stock returns? And since it's in North America, I'll say particularly in North America.
I could just take it. I've been looking kind of at a higher level on the oil side. I think it still is largely a macro call. It's based on what you think is going to happen in the economy from here. You know, if the Fed keeps pushing on rates and then something breaks in the market and we have slowing GDP, well, then, you know, what pricing is telling us now is pricing's still pretty strong given the worries around growth. Usually you would see lower prices, and we've stayed above 70. So I think that shows you how tight the oil market is. It's definitely tighter than gas. So luckily sometimes you can just follow the prices and that'll tell you what you need to know. Inventories are low, oil's tight, even though global growth expectations have slowed and people are buying less oil, you're still at a pretty strong price. So just for the oil stocks, they have the ability to generate more cash flow for investors, I think, than gas definitely does. But still, if you put it in perspective, every 1% growth change in global GDP is basically 1 million barrels a day. So that's kind of how you need to look at it. So it's really going to depend whether you think oil goes higher from here, is if you think global growth is going to hold up or accelerate, or if the Fed is going to break something. Right now, the market is shifting back into, we think growth could be okay this year. People are still employed, and that could be pretty decent for oil, because oil at this level, still some of these stocks look decent on their free cash flow yields.
Ayesha, you have your hand up. Go talk.
Yeah. So I just wanted to say, yes, I completely agree with Scott on this. I think, you know, the level that we're seeing right now is not commensurate with a recession. And this is something I've been saying, and no one seems to understand that even at $75 a barrel, it's still pretty expensive, right? It's not what we should be experiencing in a recession. Now, having said that, I do think that we're going to see some sort of recession. Technically, we may not go negative growth. That's, you know, still debatable. I think we do go negative growth in the US, and I think globally growth slows down massively. But at the same time, given the tightness in supplies and given, you know, that China's reopening, as you just said, there are other factors that's driving demand as well, right? And so I think, you know, oil prices, they stay somewhat, you know, in a weird range for the next 6 months or so, maybe between 70 and 80. But I think towards the end of the year, we do see an uptick in the prices. And, you know, going back to what Scott said, if that's the case, then we definitely see more cash flows coming through from these companies.
Well, I think, and I'm curious if anybody else agrees with me or wants to comment on it. You know, we do have the Inflation Act, right? That really starts at the beginning, supposedly starting at the beginning of this year. And so the U.S. has a lot of these projects planned, you know, as far as building out railroads, fixing bridges, et cetera, which all requires a lot of metal and a lot of energy. So even if we do see a decline in GDP, are these projects still going to make their target or be on target, and which would mean that we're still using a lot of energy regardless if we're in a recession, because of it's, you know, it's basically stimulus, right?
Hey, so I think I have a pretty different view. I think, Tracy, I agree with you that the Inflation Production Act will generate demand for oil, among other things, ironically. But I think we've experienced at least one negative GDP quarter in the U.S. And depending on how you interpret some of the economic data that's come out somewhat recently, you know, like if you look at this jobs report that the market rallied so aggressively on, there were huge adjustments in there. And so if you look on a sort of more normal basis, it does look like on a real basis, so net of inflation, we may be in a recession of sorts in the US. And I think when you look at the impact of China reopening versus a potential sort of further slowdown in the U.S. versus the stimulus in the U.S. and around the world. There's still huge stimulus spending, and Europe reopening after their energy crisis and so on. I don't know. I think we may have seen essentially the recession type impact that one would expect, especially when you look at the fall from recent peak oil prices to recent trough oil prices. There was almost a 50% decline in the price of oil. I think it was like a 45% peak to trough decline, which is consistent to some extent with what you would see in a inflation-driven sort of shorter downturn. So I think that we're pretty well positioned, and from an oil price perspective, to see much higher oil prices over the next year. Maybe it doesn't happen tomorrow, but as the inventory impact plays out. And then just on the stocks, I think there's a huge difference. I mean, it's not just my opinion. You see in the different investment bank reports and so on, the oil price that's priced into large cap US producers, for example, versus the price that's priced into small cap producers is radically different. You have producers trading at 6 or 7 times EBITDA on the large cap side, and you have producers at 2 times or so EBITDA or 3 times EBITDA on the small cap side with similar measures on other metrics. And so I think there's a chance. So we saw larger caps outperform on a relative basis over the last roughly 18 months, which is unusual for the early stages of a multi-year bull market in oil, which is what we've seen so far. So it's unusual, and I think that there's a good argument that we see these small caps that are priced at radically lower valuations with much lower implied oil prices outperform over a variety of circumstances. So they've underperformed relative to expectations over the last 18 months. I think there's a good argument that they materially outperform because of valuation, as well as just intrinsic upside from that low valuation over a variety of oil prices over the next couple of years.
And maybe, Tracy, maybe I can add to that. Josh, I think, you're spot on from a fundamental basis. You're seeing the oil price that's the oil or / natural gas price that's getting baked into these companies. I posted something into the Nest. Guys, this is attribution from March 30th, 2020. I took the low. You can argue you should take year end, but let's just take the low, COVID lows to yesterday. This is attribution of the XOP ETF. So all the names within the XOP ETF divided, categorized, by market cap. So mid, large, small. What's interesting here is the market capitalization range that did the best. So XOP, this is on a total attribution basis. So it's up 365%, but mid caps are up 576%, large caps 370%. But look, when you get down to small caps, up 118%. There go the opportunity, right? And I think that there's obviously the data here is that capital went very much into large and mids, small lagging.
Excellent point. Excellent point. I also wanted to have another. This is for anyone. I'm sorry, my cat's going crazy in the background. We're looking at the cost of production. I mean, oil prices have risen, but also what is cost of production risen in the United States or in Canada even, because we have central banks raising rates. That's more expensive for them to get for loans. We still see supply chain issues in the industry that are just seem permanent compared to other industries. And so how much has the cost of production risen, say, over, since we started, since over the last year or so? That's a question for anybody.
I don't know the specific numbers on percentage-wise how much it went up, but I can talk about what usually happens in a cycle. What usually happens is when oil prices first recover, the producers see an expansion in their margins. They're making more money. Things are looking really good for them because things are still weak. There's excess capacity. Schlumberger has extra rigs, and so they can't really ask for price increases. Then you get to a point where those E&Ps have used up all the idle rigs. Then you start seeing prices increase from the service guys. Then their margins start going up. So that's what we've been seeing later in 2022. That's why Schlumberger's, the Halliburtons, their stocks have been outperforming the producers. So what typically happens is at a certain point, margins top out for the producers. Then the oil field service guys, their margins expand. Then they top out for them, and the whole cycle is kind of plateaued. We're still at the point where the oil field service guys are able to raise prices and ask for better terms. Their margins are going up, but the producers, their margins may have peaked. That doesn't mean that they aren't at good levels and they can generate a lot of free cash flow, but things aren't generally getting better. And so you're going to see, if the oil price goes higher, a lot of that will accrue to the oil field service companies, not the producers, if you look at margins.
So I brought Christine in there. Christine, did you have a question or a comment?
Yeah, I just wanted to jump in and speak a little bit about the pricing and kind of how that plays out. So essentially, there's two types of contracts. There's long-term, master service agreements, and then there's also, short-term contracts, maybe it be one well or, a couple wells. And so really over the last couple years, the operators have disproportionately benefited from this run, because during the down cycle, a number of them had locked in long-term contracts at low rates. And then also there was this glut of equipment. So service companies had kind of underbid each other, in order to get that work. And then over the last year or so, that's kind of burned itself off, whereas now, like, all the active equipment, has all been spoken for, and people are kind of standing in line waiting for that next rig slot when it comes available, if they don't currently have a master service agreement. Plus, those master service agreements, each year, some of them have re-rates written into the contract terms, which will adjust on an annual basis based on inflation. So the kind of the answer to your question is, this is like all in flux, because it takes time, for these low rates to kind of work their way out. And what a lot of operators are reporting now, especially the ones where they don't contract in terms of long terms, they just want a couple wells drilled. Well, they're at a point now where there's a little bit of a standoff, in that they don't necessarily want to pay these higher rates. And yet, the service companies are like, well, we're just not going to give it to you cheaply anymore. And they can do that because they're pretty much tapped out. Like, the number, and this was just said on the NOV call the other day. So, I mean, people who are interested in what I'm saying, go listen to those comments. The number one factor right now for North America to scale up, it isn't legislation. It isn't, drill sites or anything else. The factor is people. There just aren't any, any readily available bodies ready to go and do this work, and there's a training period, to get them all trained up. So, and the existing crews have been just like working nonstop, for a couple of years now. They're tired, they're burned out, they need some relief. So I think we're going to see, like, just this steady gradual re-rate on operating cost, and it's going to continue to climb, over the next year, 2 years ahead. I mean, that's one reason why, I'm like heavily invested in services, because, I see it quarter over quarter. I mean, Neighbors Drilling, which has the largest drilling rig count in the world, they just increased their EBITDA 20% quarter over quarter. So what does that tell you, in terms of their margin? And as these contracts are coming up and, and are readjusting, I mean, they're getting much more favorable terms, and the operators are going to have to basically share their profit margins with the service companies, which is how it should be.
Excellent. I mean, I think that's all really great information. And especially to, we've talked about this on my spaces before, how there's just no interest in the oil and gas industry anymore. And so you're not seeing, people used to, study oil and gas engineering, even, for example, in college, and you're just not seeing the new generations interested in this. So I think we're going to have persistent labor problems in this industry as well. And then to the other points that you were talking about, I mean, we're still seeing, Josh brought this up earlier, we're still seeing, rigs decline, and we're seeing another great duck decline now. We're going through ducks like water again, and there are very few of those left. So I think that speaks to probably more of the upside in this industry as far as price is concerned over the long term anyway.
Yeah, Tracy, you make a good point with the ducks, because when you have those, you've already done half the work. And so you avoid those price increases because you just need to complete the well. You don't need to pay the oilfield service company to do as much work. So that also leads to, it's going to take longer to ramp up production now, because ducks, last time I looked, were at like a decade low. So they basically, producers relied on those to grow last year and the year before. But now when you have services guys raising prices, that's going to show up more, and it's going to be more expensive to drill a well because you have to go through the whole process and pay today's fee. You basically didn't pay a different fee before, then completed it at a slightly higher fee. So that leads to less production and higher operating costs.
Do you think that will in turn, that leads me to another question, is do you think that will in turn start hurting profits if oil prices even stay here, right? So even at 75, if we're looking, if just say, for example, we stayed at 75 for 2 years, and these production increases in cost are increased, then could we see, declines in earnings, essentially?
I'd say yes. If you look at the last cycle when shale came on the scene, 2011, 2012, I was in the industry, like on the ground every day. Unfortunately, flat commodity prices doesn't mean flat margins, because generally the service guys are raising prices and things are getting tighter. So as a producer, you start to get a little bit of a drag on your margins. If you go back and you have a good service that graphs different companies' margins, you can see they kind of peaked in like 2011. And then as prices stayed around, 80 or so, 80, 90, they just kind of dribbled down a little bit. They stayed high, but they had peaked for good. So I think you're right on with that.
I think these are good points, but it's also complicated because of the fall in natural gas prices recently, which hasn't yet flown through it's just starting to impact services pricing. It hasn't yet flown through into the financials beyond, it's just happened. So you wouldn't see it in the historical financials for services companies. And I think there's room for this to be quite choppy and complicated for the next year or so. But at $75 oil, again, from what I'm hearing and seeing, there isn't a full cycle high positive return for producers in drilling in aggregate. And so I just think that the price itself is unsustainable. And I think like generally sort of high level economic analysis that indicates that it might be doesn't incorporate things like inflation, where when you look at that's, let's say 2010 to 2012 period, a dollar then might be $1.40 or $1.35 right now. Maybe it's more if you use a sort of less adjusted inflation measure. And so I think it's a sort of complicated situation. I like services also, but I think it was a sort of up and to the right story, and I think the recent move in North American natural gas prices makes that more complicated, especially for onshore services.
Yeah, but Josh, you also have to remember that a lot of the North American rigs, I mean, the market's essentially sold out right now. So even if these rigs are leaving, gas basins, they're just going to be shifting over to, oil wells. And they can also be used as workover rigs. And this is something else that a lot of the service companies are reporting. I mean, NOV mentioned how, there's a high demand right now for workover rigs, which basically means that they'll take an existing well, they'll run in there and they'll do like a different type of treatment to it to try to clean it up and get it to produce more. Maybe they'll change the tubing size. I mean, it's, now we're kind of getting into the weeds on production engineering, but there's going to be continued sustainable demand for these services. I'm very bullish on that.
Okay, Ayesha, you have your hand up.
Yeah, just a quick question, actually. We saw that Chevron and some of these others, they paid off a lot of their debt, right, in the last 1 year because of the cash flows that they've raised. So, does anyone actually have any idea how much the debt burden is at the moment for the oil industry? Is it still as high, or have most of the other, smaller companies as well paid off their debt? Because that will obviously make a big difference in terms of, the cost of capital going up.
I can speak to that a little bit. I think at least gas and oil, they've been paying down debt, and obviously the debt to EBITDA ratio, which is what most lenders look at, is very low because EBITDA is so high. But these guys are in pretty good shape, so they have room to borrow if prices are low or if they want to ramp up, because they did basically there was a gush of cash the last 2 years. Most of the big companies have paid down debt. The smaller guys who used to be in trouble made that a priority and paid down debt. So debt levels look pretty healthy across the industry. I don't know exactly in the small caps, but mid and above, they're in pretty good shape. So they have room on their balance sheets if they need to borrow for whatever reason.
Yeah, that's kind of what struck me as very interesting when I looked at, the majors, right? So that's a good strategy to employ, basically, not just for, the oil industry, but for most of the other companies across the board, where they've sort of been refinancing their debt, pushing out the maturities, doing what they can, because to some extent they kind of realized that this would be coming, right? The Fed would be raising rates. So that's a good point. Thank you, Scott. Thank you for answering the question.
Yeah, if you're a good operator, you should know that this is how the cycle works. You can't just be taking on debt when times are really good and being like it's all good. You need to go counter cyclically. When you have tons of cash, pay down the debt. You're going to need to borrow sometime in the future.
And then I had one last question, and then we'll do the roundtable lineup. This is kind of more of a technical question. With natural gas prices, and this is for anybody on the panel, with natural gas prices this low, obviously there's no hedging going on. So how do you think this is going to affect, we already know that markets are somewhat almost illiquid, right? Open interest is horrible. It's coming back a little bit, but how do you think this affects open interest as far as the natural gas market is concerned? If you're, just trading, say, the futures, for example. Does anybody have a comment on that? Or an answer?
I know some of the natural gas traders that I talked to were a little frustrated when the fundamentals for gas started to look less good in Q4 last year, and they were observing that retail investor flows into UNG and Boyle, the 1x and 2x levered sort of ETFs for natural gas futures. They were observing that those were materially affecting the price, which is not really supposed to happen because it's a physical commodity that should ultimately price based on supply and demand. It looks like that's sort of gone the other direction to some extent because of the giant losses that those positions have experienced. But it was interesting to me that there was this view of a material effect on the commodity price by those actors, and that could only happen in a very illiquid, low participation market.
Yeah, that makes sense. All right, so we're past an hour. I like to keep it generally about an hour because I know everybody has busy days, and I appreciate all the speakers taking time out of their day to join us. So really, I just wanted to go around one last comments, closing thoughts, and anything that we didn't talk about that you kind of wanted to touch on and what we should be looking forward to in 2023. We'll start with Ayesha.
So I kind of, put my thoughts out earlier as well, but I think I'm just going to reiterate. So I do see us experiencing a recessionary environment, even if it's not a technical one, but I do think we will slow down massively. And even, a period of prolonged slow growth can have the same effect as a technical recession. I think we're still in for some pain where equities are concerned. I don't think we have bottomed as yet. I think the Fed is not going to cut rates. I think they're not done hiking. I think they're going to hold rates, at a higher level at least till the end of the year. And these are just my views from everything that I've been studying, everything that I've been looking at. My target on the S&P is somewhere around 3,200, maybe lower. In terms of earnings, I think we are experiencing an earnings recession already, and we will experience a deeper one next quarter. As far as oil and gas is concerned, gas, I'll leave it to the experts here, but oil it's as I said, I think until, the mid-year, we see prices bobbing along as we are, but I do see higher prices towards the end of the year, possibly $80 on WTI, slightly higher on Brent. Yeah, and that's it. Those are my calls for the year.
Thank you very much. Josh, final thoughts, or talk about anything that we didn't cover that you wanted to cover, and kind of where you see the industry for at least, 2023, 2024.
Sure. Yeah. So I think like the short term is uncertain and sort of hard to predict, but over the next, let's say 6 to 18 months, I think oil prices go much higher, and I think services may be rough, especially onshore for the next little bit, but then should recover, and with higher prices, services companies should do really well. And again, I think the real sort of interesting opportunity that gets missed from the popular ETFs is to look at some of these smaller cap publicly traded producers and services companies. Again, they're either not in those ETFs at all, or they're in there in very small size, and there's this just huge lag effect where they seem to have sort of unusually high upside versus the larger producers, and I guess because of fund flows seem to have lagged this part of the cycle.
Absolutely makes sense. Scott, kind of your final thoughts, and if anything we didn't cover, and what should we be looking at to 2023, 2024?
I'm going to leave you guys with a teaser. I'm going to tweet a thread today or tomorrow. I updated what was going on in the LNG market. I wanted to go really deep and figure out all the moving parts, so I looked on a global basis. So my basic takeaway is, as you look at North American gas demand, it typically has been growing at a little over 1%, which is about 1.3 BCF a day. From now until 2026, it's going to grow 3 times that amount, by 3.3%, or about 3 BCF. So that's the opportunity we see. That's why we're so constructive on gas longer term. Also, I think this is a great time to be accumulating gas names because of just how low gas is at the current price. It's competitive. LNG in North America is competitive to Asia with every other country except for Qatar, which is the world leader, but it's close. So if you're looking to buy LNG, you could, the only place you can go that's cheaper is Qatar. So it means that at this price, we'd see more signing of contracts, and then you also have the coming winter. So look out for that from me, but we are very constructive on gas, I'd say in the next year and in 5 years.
Excellent, and we will look forward to your report. And then Thomas, your final thoughts and thoughts on the industry 2023, 2024.
Yeah, on behalf of Grizzly, Scott covered the key points, and just from my perspective, what I'd like to see, I think it's going to be a good year for the barbell, and the barbell is big tech, specifically, a large value tech, and then commodities. I think we have a nice window here. What could spill the apple cart? I think a nice Goldilocks scenario would be not to see oil significantly, above 100. I think that then starts to put brakes. You start to renew the inflation issues. I think if we can get producers, if you can find producers producing cash flow that can go into dividends at, call it the $80 to $100 range, ideally call it 80 to 90, and grow production, that to me is very attractive, and you'd want to own all these names, right? I fear that if we get materially higher, if we get any sort of squeeze scenario, you just kind of get back to this ping pong. Fed comes in with a hammer. That's my fear. But putting it out there, but net, we still believe structurally this is the commodities are the place to be, and I think in agreement with everyone here. But I just would rather not see a spike up scenario.
Excellent. So thank you all. Please follow all of these people. They are fantastic on Twitter. Follow at Place Your Trades on Twitter so you know our upcoming events. Don't forget to sign up for the Vegas contest. It's a free trip, why not? Again, thank you guys so much for taking time out of your day. I really appreciate it. I'm sure everybody that listened here today really appreciates all of your comments. We covered a lot of ground today. I hope everybody has a great rest of their day, and we will see you next Wednesday.